Hi, everyone. Today is March 10th, 2022. The war in Ukraine continues. I think it's entering its third week. So we're going to do a reassessment of what happens to the stock market and other personal wealth in wartime. We're going to be looking at, defense contractors, gold, cryptocurrency, and also, look, gasoline prices just hit an all-time high. And we're going to see, does that stay there? How long does it stay there? How bad is it going to be? How bad will Russian boycotts affect US companies and the US consumer and investors? We'll unpack all of that in just a few moments. So thanks for joining me today. Again, I'm going to jump right into the PowerPoint, and we'll be discussing as you see the visuals. So, I mean, sadly, why we're here is because of the invasion of Ukraine. There was a lot of saber rattling, and then it just happened. Here we are now entering the third week. So I think first and foremost, at least I stand with Ukraine, and I'm praying for peace, for no more bloodshed, that the invaders return to Russia, for Ukrainians to return home, for rebuilding, for accountability for the war crimes, and that Russian protesters are free to elect a leader who represents their values. Now, the S&P 500 lost over $1 trillion on March 7th. And you might say, oh, well, we had another down day. Well, actually what we've had since then has been a little bit of uptick. So yes, today was down, but you can see that it's not as low as it got on Monday. It got much lower. That doesn't mean that it can't go lower, and we'll be definitely talking about that. But I did want to say is that what we're seeing now is a great deal of volatility. And clearly the only bright spot here is energy at 37% year to date. Everything else is down a lot, including information technology, which is essential to all of us, including, soldiers. And a lot of that has to do with price and valuation. So we will be talking a little bit more about that as well. I wanted to point out that utilities have been pretty stable. They're about flat, and consumer staples have been not hit as hard. So how do stocks perform during wartime events? And should you be getting defensive or buying into oil, gas, gold, and tanks? Again, we just said that energy was the only bright spot, and utilities and consumer staples. And that tends to be the case. Doesn't mean that they won't go down in value. It means that they tend to be a little more buoyant. As we're going to talk, and as I'm going to show you in these slides, war is terrible for stocks, and it usually does start with the invasion. So sometimes before. We had a double whammy. So we have the invasion of Ukraine, and we also had the US equities, not all equities. Chinese equities weren't as elevated. US equities were at an all-time high. So we're going to be talking a little bit more about how that plays into it, how elevated asset prices create additional problems for us. So before we do that, let me show you where you can get additional information. So at nataliepace.com/blog, that's where all of my blogs are. If you need a link to a particular blog, you can always email us at info@nataliepace.com. But the one, Ukraine invasion, this was written the day of the invasion. And what I did is I went back and I just looked at what happened in Pearl Harbor. I looked at what happened at 9/11. And as you can see here, it's quite interesting because Germany invaded Poland and the US was not involved in that conflict. And yet the US stocks went down 3%. And then again in 1940, and then again at 1941, which is when we had Pearl Harbor at the end of the year. And the interesting thing is that that's when the bull market began the following year, just days after Pearl Harbor. Now, of course, we all know that that was probably because the war ended, but we're seeing something similar trend even in 9/11, is that we can have a 2 or 3 year correction and then it tends to start the bull market. So even though we were involved in wars, still in 2003, we had a robust year. The NASDAQ Composite Index lost about 78% between March of 2000 and the low of October of 2002. And then in 2003, it had 55% gains. So one other thing I wanted to point out here is that the market started dropping before 9/11. So we had a down year in 2000, and before 9/11, the markets had already dropped another 20%. And then, yes, they did drop further at 9/11 and towards the end of September. But after that, we had a pretty good Santa rally. And personally, I just wanted to say this real quickly. I had actually bought some stocks, two stocks that I really liked in August of 2001. I had watched it was a first cloud-based computing company. I had watched it go from $12 a share to $1 a share. I bought it right before 9/11. And by December 27th, it had almost tripled, and I took my profits and sold it all. So, and that was because I knew that 2002 was going to probably be another down year because of the valuations as well as the attack. So we'll go back to the PowerPoint now. And again, I'll be talking a little bit more about that, but you can refer to my blog if you want to see these particular wartime events. So 3 countries provided almost 70% of liquefied natural gas to Europe in 2021. And Russia was one of those. And Russian gas flows through Ukraine to Europe. So far, it's still flowing, but the US has banned it. And probably the reason it's still flowing to Europe is because it's such a big piece of their electric grid, some countries more than others. Natural gas prices don't follow war. So as you can see here, you can see that, they're very volatile and they don't stay high for very long. And then when they change course, they just drop like a knife. And part of the reason for that is that utilities are basic needs. So if utility prices get too high, then people get very restless and unsettled, and you can have a lot of demonstrations. Oil prices get very high too, and they don't stay there as long, but they do have more of a correlation with war. So let's take a look at the oil prices. So as you can see here, oil prices did go up in the wars, but they also went down in the recessions. So oil here was about $27 right before 9/11, and then it went back down. And when the market started to recover, the oil market started to recover was actually when the stock market started to recover in 2003. And then when the stock market dropped in the Great Recession, so did oil prices. In the pandemic, so did oil prices. This has a lot to do with when oil gets too expensive, consumers can't buy it. And whether it's too expensive because the prices are too high, or too expensive because we're in a recession and people can't afford it, or we're in lockdown and people are worried about things and they're no longer driving. That is what tends to do it. So these drop downs happen because the consumers just get fed up and they don't drive as much. So as the economists are fond of saying, the solution for high prices is high prices. So what that does is it adds a great deal of volatility to the sector. So there are over 3,000 US companies with operations and joint ventures in Russia, including oil and gas. BP was the first to divest, and they said they were going to take a material non-cash charge. They believed it'd be about 25 billion. Other analysts believe that. And then they're also going to have revenue losses, which could be in the hundreds of millions. Now, ExxonMobil and Shell are exiting Russian JVs. Shell picked up cheap oil on March 5th, but they won't be able to do that going forward. We have outlawed Russian oil, so it's unclear what's going to happen with ExxonMobil, Shell, and Chevron. They should be making announcements. They may have made it. Of course, the boycott just happened yesterday. They may have already made it, but they should be making soon announcements similar to BP made, where they have to divulge to their investors how much it's going to cost, whether or not it's a material non-cash. They may, if they had provided a forward outlook, which many companies haven't done, then they may have to adjust that based on not receiving revenue from Russian operations. So again, the one company that divested itself from Russia was ConocoPhillips in 2015. But most of the other ones, they are, they're going to have to obviously tell their shareholders what's happening, and soon, if they haven't already today. Again, the announcement was yesterday. The solution for high prices is high prices, and it's horrible and horrifying that people who can't really afford and are already suffering from the pandemic are having to deal with this. But obviously, that's nothing compared to what's happening to all the refugees from Ukraine. So the U.S. will probably not smart from oil embargo as you might think. We basically produce about the same amount as we consume. However, it has been a very fluid market. So we might import some petrol fuels from Russia to make plastics, and then we might sell our gasoline to Mexico because we can get a higher price for it. So it has been a very fluid market, but it is important to know that we became a net exporter of oil last year, actually 2020, and we have been very close to oil independent. Although it doesn't mean that we are exactly oil independent because we do a lot of trades, but we definitely produce the same amount that we need to consume. Here's the oil stock report card. So as I was saying, the oil prices, the sales growth is looked great last time, especially year over year, because it was beating the pandemic. But if there's a material non-cash charge, the earnings and also the revenue might not look as good. Conoco may be the exception to the rule. And it does have still, not too lofty for that kind of year over year sales growth. So just be aware of that. You can see that investors were pricing in on BP their announcement. So when and if Chevron and Exxon have to make their announcement about divestiture, you might see them experience some weakness as BP has experienced. Now, what about gold? So gold prices and war are interesting because there's really not any correlation. What tends to, and it could be, like in the gold was nationalized by FDR, and people weren't even allowed to hoard gold until 1974. So of course there was all that period where there was no correlation in there. But what's really been highly correlated with gold prices going up, and silver is like a cousin of gold. It usually will go up with gold as well. What is highly correlated? If the stock market goes down, when oil prices are really high, gold prices are usually going to be in favor as well. And then also when people lose faith in the dollar, that's when they start looking at gold. So we are seeing strength in gold. Now, I've been telling people about silver, and the reason for that, and I'm going to go ahead and show you the silver chart here, is that silver is at $24. Its all-time high that it hit when gold hit its prior all-time high was in 2011, and it was about $47. So this one has more of a run rate. And again, as you can see, if I compare this to GLD, you're going to see that it really does shadow gold. This particular cycle, it's been underperforming, but it does have a strong correlation. So I think that anybody who likes gold might be more excited about silver. Oh, I'm sorry, I didn't show you that. Sorry about that, guys. Here's that chart. So, and here's where gold's all-time high was, right there in 2011 of 47. And that's when, silver's all-time high, and that's when gold's all-time high was as well. So it's important to realize that the younger generation believes that cryptocurrency is more exciting than gold when they lose faith in the dollar. And that is probably had a lot of effect on why gold and silver haven't had a major run up to date. Now, there was one other chart that I wanted to show you. Just give me 1 second. I'm going to pull it up for you. I think it might be just right behind this one. There we go. Okay, here we go. So it's this chart here. Back when gold hit its all-time high, you could see that it looked like the only thing that you would want to invest in. But whenever you see an asset that goes that crazy above its trend line, it's usually a bubble that's waiting to pop. So those people that were, getting sold into gold IRAs and everything gold in 2012, that wasn't the time to really be doing that. Now you can see the 10-year return on gold, it's the worst performer. It's under 1% on a 10-year annualized. And on the 30-year, it's about a little over 5%. Conversely, you can see that real estate and stocks are above their trend line. So real estate has become rather unaffordable and stocks are overpriced. And why do I say they're overpriced? Well, that's based on the Buffett indicator. I think I might have it here. So as you can see here, this is Warren Buffett's favorite market valuation tool. And basically it takes all the publicly traded stocks compared to gross domestic product. And you can see that where we are right now is higher than it's ever been in history. Now, the last 2 times it came close based on this indicator were the Great Recession and the dot-com recession. Dot-com stocks lost 78% in the dot-com recession. You had $1 million, it went down to $220,000. And it took 15 years to crawl back to even. In the Great Recession, the stocks dropped 55%, and then you had to use the bull market to try to crawl back to even as well. That's not really a plan. So we will talk about modern portfolio theory, pie charts, and regular rebalancing. Those strategies, which are easy as a pie chart, earned gains in the dot-com and the Great Recession and outperformed the bull markets in between. A lot of that had to do with bonds earning a good return back then because interest rates were starting at a higher point. That's not the case this time around. So this time around, you have to know what's safe. So in addition to having potential weakness in your equities, your safe side could potentially be illiquid and negative yielding as well. So you want to make sure you know what you own and why on both sides, the safe and the at-risk side. So again, gold prices did drop in the Great Recession. And then they started the rally right after the Lehman Brothers bankruptcy. And they obviously were one of the top performers by 2011. You just saw that 10-year chart. And you saw those two as well. And this is that chart that I was telling you about, the silver compared to gold. So if silver's high previously was 47 and it's 24, that has more of a run rate than, gold's high is like a little over 2000 and it's very close to 2000 right now. So meet the newest defense contractor, Microsoft, IVAS goggles. So here's a defense contractor report card. And it doesn't look exciting now, but Biden did increase the defense budget by about 5%. And definitely, you're going to see these contractors benefit from that, especially, he increased the budget obviously for a reason. So one thing I wanted to point out is that a lot of these companies that have the better sales growth also have very pricey price to earnings ratios. So it's already overpriced in. So just be careful about thinking here that defense is your answer. So we already talked about that, but there's the chart for you. Now, ExxonMobil followed the S&P 500 between 9/11 and the bottom of October of 2002. So 9/11, which was the worst attack on US soil since Pearl Harbor, it didn't help ExxonMobil to swim against the tide of the correction. And I think that's what's really important for us all to realize, is that usually what happens is that high, overpriced stocks can start going down. And it's very hard for even something that's in favor to swim up against the down current. So you must be aware of that. Part of the reason, especially for oil and gas, is that as stocks go down and family wealth goes down, and then people start not wanting to drive as much, and that impacts, obviously, the demand side of oil and oil prices. So again, stock valuations were a problem before the terrorist attack on 9/11. Most people don't realize that the market started correcting. The high was March of 2000. 2000 was a down year. 2001 was a down year. Before 9/11, even before 9/11, there were already about 26% losses from the high in March in 2000. Then 9/11 happens, and then we have this really strong Santa rally. And then, of course, the next year was another down year. So again, stocks dropped before Pearl Harbor. 1939, Germany invades Poland, stocks were down. 1940, stocks were down. 1941, Pearl Harbor. And then we start the recovery after the war ends. So again, as I said, stocks are pretty negative for, wars are very negative for stocks. When stock prices are elevated, you have to ask yourself, even with defense contractors, and even with, like we saw that gold can get dragged down in the beginning. You have to ask yourself, what can the company do? What can the industry do? And what is the marketplace going to do? Now, we also teach people, especially for individual companies, the 3-ingredient recipe for cooking up profits, the stock report card, and the 4 questions for picking a leader. So we have stock picking tools that we teach on one full day at the Investor Educational Retreat. So you can find the biggest winners and the biggest losers. But you must also know, again, that this one, what is the marketplace going to do, is a big deal in when markets are overvalued and there's a war. So what we're doing right now is you always want to keep a percent equal to your age safe. In volatile times, you can overweight safe. We're suggesting 20%. You could do 10, 5, whatever you want. And then you want to be properly diversified. You want to have large, medium, small, value, and growth, and 4 hot industries. If you think that oil is super hot, you can do that. I put in clean energy because when oil prices get really high, people start getting more interested in electric vehicles and solar power, especially when when their utility bill gets high as well. So it's usually very positive for clean energy. And of course, you could have gold, silver, or crypto. Cannabis is very undervalued in my view right now. And technology and biotechnology are hot. I think technology might still be a little pricey, and some biotechs might be very undervalued. So again, you want to rebalance regularly. The nest egg pie chart system with regular rebalancing earned gains in the Great Recession and the dot-com recession, and outperformed the bull markets in between. You need to know exactly what you own and why, and don't have blind faith that someone else is protecting you, because buy and hope doesn't work in 21st century recessions. These recessions, which are built, because the pricing gets too overinflated, they crash farther, they crash steeper, they crash faster and deeper. That's very different than last century when buy and hold worked pretty well. So now is the time when you really do want to know a time-proven 21st century system and what you own and why. And again, on the safe side, a lot of people will either be in bonds, which are illiquid and negative yielding and are not going to do well in a rising interest rate environment. We could have 7 to 9 hikes this year. That could put us over 2% on the Fed fund rate. And while that's still very low, it's very much higher than it is right now. So as interest rates rise, the bond value of existing bonds go down. So you really need to know what you own on the safe side. And money market funds are vulnerable and they have redemption gates and liquidity fees. So, and oftentimes the small amount of interest you're getting is completely wiped out by the fees. The fees might be small, but if your interest rate is small, then your fees could be more than your interest rate. So, and there are ways, even if you have a 401k, to get a little more safe. So again, this is where we are. We are at very pricey valuations for stocks. So now is the time where you can actually protect your wealth. You might feel like it's come down so much, but it hasn't come down so much. It has absolutely come down, but here's something that could soap you up a little bit. Let's just take a quick look at the S&P 500. And if we click on max, you can see that our small correction still looks very, very high. So now is the time when you really want to know what you own and why. And you can email us at, sorry, you can't see that so well, info@nataliepace.com. You can personalize your own pie chart using our free web app. We also have a rebalancing blog. And obviously, if you're on this video conference, you know that we have free video conferences. Visit nataliepace.com. I have at least 4 or 5 blogs on this war. So nataliepace.com/blog. You can get my video conferences to playback at youtube.com/Natalie Pace. You can see my most recent interview with Lizanne Saunders. It was before the war, but she was already getting a little bit, definitely telling people to get a little more defensive. All right, so there's still a couple more quick things I want to tell you, and then we'll open up the lines and see if you guys have any quick questions. I want to remind you that we are hosting an online investor empowerment retreat next weekend. So again, you're going to learn the pie chart strategies, you'll learn how to pick stocks and how to avoid the big losers. And we spend one full day on what's safe. It's very affordable. And if you have a lot at stake, you're going to be very happy that you invested in getting wisdom. Just email info@nataliepace.com or call 310-430-2397 if you'd like to learn more and to register. You can also go to nataliepace.com. We have a flyer on the homepage. If you click on it, it'll take you over for testimonials. You'll learn the 18 things you're going to learn and master. And you can also get pricing information there and other details. All right, so I guess in a nutshell is that, yes, you could say oil and gas, but it's kind of priced in right now, and the Russian boycotts don't portend well for most of the US companies. Also because consumers can, especially since we have work from home and that sort of thing, if consumers decide that they don't want to drive as much, then that could help prices come down. So it's not that prices stay at these lofty levels for, at least in history, for very long. And the main reason for that is the consumer will stop demanding as much. Again, I am a little bit leaning into silver. I'm leaning into clean energy. Some of them are still very low priced with low price earnings ratios and high sales growth. And there are other things that we can discover at the retreat, or you can read my blogs for other things that I'm featuring and highlighting as well. All right, so I'm going to go ahead and, well, let me tell you other ways that you can reach me. If you are interested in, information about Ukraine that comes directly from the president of Ukraine, rather than all the news sources and other things that might be misleading, I think getting the information straight from him, he sometimes is walking with a camera and showing you things that are happening, and from the First Lady can be very helpful. I'm doing that on Instagram. So you can capture all of my social media on, just go again to nataliepace.com, and what you'll see there are clickable links to all of my social. Instagram, Twitter, Facebook, LinkedIn, YouTube, that's where you can watch back all of our video conferences. And again, in the menu over here, you can learn more about the blog and about me and other things that you might be interested in learning about. Okay, so I am going to stop it there, and thank you for joining me. I will open up the phone lines, but I will stop the recording so that if anybody has a quick question, I'm happy to answer it. We don't have a lot of time, but we definitely can get in one or two. So the question was about rebalancing. So at the retreats, we say, look, you need to rebalance once, twice, or three times a year. And a lot of times good moments to do that they're not foolproof, but it's good to keep it in mind after the spring rally, after the Santa rally. And then at the end of September, if the September has been a down month and the summer has been weak, then you maybe have some back to school stock sales. So those are strategically relevant times. But you also have to let your portfolio tell you when you're rebalancing. So as an example, we listed Moderna as our company of the year. It's trading at 150. And then I was all over social media when it hit 444 saying, look, even though the price earnings ratio is low, even though the sales growth are so high, this is the time to capture gains. And again, it wasn't that it was a specific date in mind. It was that had just shot the moon. So what we saw in 2001 was shoot the moon, new investors. So things got very volatile. And so if you, in between your rebalancing, if you happen to notice that something has gone crazy, like Bitcoin would be another example, right? The high was 69,000 and now it's probably, I didn't check it today, but it has been trading close in the, just under 40,000 again. Well, if you have the pie chart system and you have a slice of Bitcoin and it goes to 3 slices, then it's screaming at you to sell 2 of those slices and trim it back to 1 slice. So again, the pie chart system, especially if you are being led, if you go to your portfolio and you see something has doubled or gone up 80 or 90%, don't wait and say, okay, I'm just going to wait until April, especially when the macro trend has so much pressure for downward movement. So I hope that answers your question. Okay, so this one is about the dollar. And I think that look, part of the thing that's going on in Ukraine is that Russia is trying to just make its country more relevant and bigger, and also to break the US dollar dominance. That's something that they've been trying to do for a very long time, for years. So what's happening in Ukraine is very similar to what happened in Crimea, and also what happened in Syria, by the way, too, under the former president. So it's really, I think, important to realize that the dollar and the US economy, everybody is in the same boat. So there is not a country on the planet right now that has very, very low debt. There are countries that have lower debt, but everybody got hit very hard by the pandemic. And the countries that have lower debt, it's just unlikely that you're going to see them become the reserve currency of choice. We are seeing a move more towards a basket of currencies. So what I would say is this: the first thing that's really important about this is that you being concerned about the dollar can drop you into a social media vertical where you actually could be exposed to scams and panaceas. So what happens a lot of times is that when people get worried about something, then someone comes along, a snake oil salesman type person, and these are convincing people, and they say that dollar is going to become worthless, and now you just need cryptocurrency, or now you just need gold or silver, or buy. I've even heard people say to buy Iraqi dollars, the dinari. So what I would say is be diversified. Understand that in volatile times and in times of uncertainty, and especially when asset prices drop, that safe income producing hard assets that you purchase for a good price can be the best thing. There are safe income producing assets that you can purchase for a good price right now that many people aren't considering, that we talk about on day 3 at the retreat. So what you want to do is position yourself best for a world where inflation is going up and where there is a lot of debt. But it's not just the US that has it. China has it, Russia has it. All of the major global leaders in the world have massive amounts of debt. And with Russia being less so, but still so, you know, with China and the US, we're China's biggest customer. So if something happens bad to us, it affects them as well. It's an interconnected global reality. So I would just say is that your best protection against being worried about a very weak dollar or dollars becoming worthless is to first understand that the US is not Germany. We have it, you know, we've been inventing the things that the world needs. We invented the internet, we have biotechnology, we have a lot of things that the rest of the world really relies upon. That is a driver of economic growth, and that is a driver of strength. The biggest problem that I see right now, in addition to the amount of debt, is that prices on everything are overvalued. So I think you should be very defensive about anything that you might be invested in, whether it's your own home or even your stock portfolio or your retirement plan. You just want to make sure you know what you own and why. On your home, if you bought it in the last 2 or 3 years, you better make sure that you can withstand if prices go down, because prices dropped, you know, pretty much by half in the Great Recession. So, and being underwater on mortgages can be real hard, and that can last, that kills your credit score, freezes you in place. You can't go if there's a better job opportunity elsewhere, you can't sell it. So it becomes a real hardship. So I'm going to stop it there. But again, I want to thank you guys so much. The real solution to any uncertainty is always to be diversified. And again, we're leaning into a lot of things that actually reduce your expenses so that you can be more self-sufficient, that you can earn money while you sleep in a 21st century time-proven plan, that you can start thinking about income producing assets that can actually keep you afloat in tough times, that sort of thing. So I think you should learn them. At minimum, read about them in the ABCs of Money. If you have a lot in your 401k or your IRA or your RSP in Canada, and by the way, Canada, when US sneezes, Canada catches a cold. If you have a lot of money and you really want to know what you own, even if it's managed by someone else, I don't sell financial products. My opinion is unbiased. I want you to have the information that you need to be the boss of your money. All right, I will see you guys probably in April, unless you're coming to the retreat, because I usually do these video conferences once a month. And I'm also going to be part of an Earth Gratitude celebration on April 22nd. Go to earthgratitude.org for more information on that. All right, see you later, and thanks so much for being a part.
Thank you, Natalie.